So we're here at Corn College with Bob Utterback. Just gave a presentation about the futures market strategies. What should farmers do given the volatility in today's market?
Well, I think the first area that you focus on is if you're in the central and eastern corn belt in a yield deficiency area and your crop insurance is going to be your main cash flow, you have to start thinking about, do I lay off risk and protect that crop insurance against the 2008 surprise when the market went from $8 to $3 because it had an outside fundamental event. I'm not saying it could occur, but the dollars and cents on the table are getting so significant. Can you afford to not have the crop insurance premium there? And we could be several $100s an acre if you went from $8 to $7, which is, harvest pressure, political activity event. I'm not saying it could occur. I think it's low probability, probably below 30%, but it's a risk I would suggest to you. That insurance is very dear. So I would be looking at buying a December put. We get back to the 8.15, 8.25 area. I'd be thinking about buying an $8 put to protect a catastrophic position and rolling that put up if we continue to move higher. But we are in an event year, as I said in my outlooks, of something of unprecedented proportion. It's going to be, the impact on livestock industry is going to be drastic, which is getting a lot of political discussion there. And my biggest fear is, will there be a political intervention sooner than later? The conventional thought is political intervention will not occur before election, and it'll happen closer to the January time period. And
What would it take? What kind of what form would it take if there were
well,
a political
I think the most
intervention?
obvious one we're talking about now is the impact on livestock industry. They're blaming the ethanol is for they want to reduce the demand side of the cycle. Is basically taking away or reducing the 10% ethanol mandate by EPA, which is, the environmentalists would push back and say you can't, you're stealing from them, and it's going to hurt the value of the farmers' grain prices that they have, that what limited grain they have is going to knock it. So you help one constituency against another, which if we start doing that, that's the worst thing we can do for us is fighting between us. We have to have a unified effort. Everybody has to make money, but my concern would be they do something on ethanol that could knock the market for a loop. And that would, if you have crop insurance, remember by the November time period, the month of October will be very critical. They could do themselves a lot of good by dropping the prices down in October to reduce the benefits. I'm not saying they would, but it's a risk. And with much political pressure we're hearing right now, I don't know if I could sleep at night knowing that I haven't got a crop and my whole cash flow is going to be in crop insurance, which is not going to be determined until all through the whole month of October. I want to kind of have that guaranteed, especially on my 820, 40 level.
Well, you mentioned some things need to get worked out in the livestock industry before you'd even consider reducing the ethanol mandate. What were those things?
Well, I think the livestock industry is now knowing that grain prices are really going to get tight. And, this winter, this summer, we had really hot, dry temperatures. I don't think it's going to affect consumption rates. So the litter sizes that we know are going to be down. So that's going to be very bullish for hog and cattle prices next spring and summer, which will affect retail prices, which will affect consumer, which becomes back to a political issue. And so a lot of people are trying to say we need to keep any herd liquidation to a minimum. But I don't think the herd liquidation is starting now. But there's more talk, and I think what livestock people are trying to get is they want to get grain prices down so they don't have to liquidate. I believe, since we're talking about it so much, that they're not liquidating their capacity until they know the corn yield is not there. And that means the demand is going to be stronger than the trade is currently factored in for the last quarter this year. And the demand rationing really won't start until the first or second quarter of 2013. And it's not going to be fast enough, because if we truly are below a 130 corn yield and heading towards 125, the magnitude of the rationing that we have to do is historically unprecedented. Mm-hmm. And this means that in a time period when you got a lame duck presidency, after administration November 7th to the new administration, will they extend the farm bill? Because the current farm bill doesn't have a disaster payment provision in it for next year. So they might have to extend the current version, not the new version, because the new version doesn't have a disaster program in it. And they got the tax bill, and there's just so many. I just don't think Washington can act fast enough to basically have policies and to bring supply acres in a conservation reserve. It seems like there's a real debate. Will they be able to act fast enough to get the acres out of production and get them into production for the 2013 marketing year? Mm-hmm. Because Texas starts planting in February, March. Can we act fast enough? And so these are some of the questions of the monstrous impact we've gone from a very potentially very bearish looking corn crop, great supplies back in April, May. Look like we're going to have too many supplies now to 180 degrees. We're going to have one of the worst disasters in the last 42 years in reference to corn and bean production.
So you mentioned in your presentation that this is an historic year. It's a year that we'll always look back to and remember.
This will be a benchmark year when you're talking to your grandchildren. I remember when. And this will become one of the new standards that we look at. And it is a paradigm, the new volatility that we're in as marketers. The problem about marketing is not a static thing. It's a dynamic thing. Marketing has to adjust to changing environmental events. And we've had an environmental event, a historic proportion, and it's caused marketing to adjust. And those that adjusted did very well. Those that just sold the cash and forgot about it, because it was the easy thing to do, have now got some hardcore decisions that they have to make that are very, very difficult. And there's no simple solution. And the consequences will be multi-years in their impact.
You mentioned that farmers need to take a defensive position between this winter. Can you elaborate on that a little bit?
The defensive position reference is, I think that when they start selling the multi-year, they need to be defensive in reference to, they need to be more on a put or a limited cash flow exposure position rather than a net short position where the cash flow could be still significant, because the story is still untold. Here's we're sitting here in August. We don't know what corn yields and bean yields, and I think this is going to be one of the rare years where the actual yield is going to be below expectations. So right now, one wants to be cautious in how aggressively you want to be short this market.
You still think we'll have $8 corn in the spring?
I think $8 corn will be a feature, with a basis. I think cash will lead to futures, and corn will be historically strong for all of 2012. Yes, I do.
Thanks, Bob.
My pleasure.